If you invest $100,000 today, will Fidelity or Vanguard make you richer? It is a question that defines the financial future of millions, yet most people are looking at the wrong numbers. We are pitting the giants against each other to see which one actually puts more cash in your pocket over the long haul. One of these funds quietly beats the other in ways most investors never notice. We are going to look at real numbers, a deep fee comparison, and a 20-year projection that might change your entire investment strategy. By the end of this video, you will know exactly which company deserves your hard-earned money, and the winner is not what most people expect. This comparison matters because index funds are the absolute foundation of most successful retirement portfolios. Whether you are 18 or 50, your choice of provider is the single most important administrative decision you will make. Most investors default to either Fidelity or Vanguard because they are the industry leaders, but tiny differences in how these funds operate will compound into tens of thousands of dollars over time. For example, a difference between an expense ratio of 0.03% and 0.015% seems like nothing today. However, over several decades, that small gap can pay for a car or a significant portion of a child's college education. Later in the video, I will show you the math on which one turns $100,000 into the most money. Let's meet the contenders. Vanguard is the pioneer of low-cost indexing, founded by Jack Bogle with the radical idea that a mutual fund company should be owned by its fund shareholders. Their most popular options include the Vanguard Total Stock Market Index Fund, known as VT-SAX, or the ETF version VTI, and their S&P 500 Powerhouse, VO. These funds track the performance of the largest companies in the United States, offering a passive way to grow wealth without trying to beat the market. On the other side, we have Fidelity. While they were historically known for active management, they have pivoted aggressively to win the index fund war. Their flagship products now include the Fidelity Zero funds, like FZROX for the total market and FNILX for large cap stocks. These funds are famous for having absolutely no expense ratios. Zero fees sound unbeatable, but as we are about to see, there is a catch that most people miss until it is too late. To see the real-world impact, let's run a simulation. Imagine you have $100,000 ready to invest right now. We will assume an average annual return of 8%, which is slightly below the historical market average to stay conservative. In scenario 1, over a 10-year period, your $100,000 would grow to approximately $215,892. At this stage, the difference between a zero-fee Fidelity fund and a low-fee Vanguard fund is only a few $100s. In scenario 2, looking at 20 years, that balance jumps to $466,000. Now the fee gap starts to widen. By scenario 3, at the 30-year mark, your investment has ballooned to over $1 million. Even with a tiny expense ratio, the compounding effect of fees starts to eat away at your totals. But fees are not the only thing that matters, because how a fund tracks the index can actually outweigh the cost of the fee itself. Let's talk about expense ratios, the hidden money drain. Vanguard typically charges around 0.03% for their flagship index funds. On a $100,000 investment, that is only $30 a year. Fidelity's zero funds charge $0. Over 30 years, if we account for growth, those Vanguard fees could total several $1,000s in lost potential. However, Vanguard still competes fiercely because of tracking efficiency. Vanguard has a unique structure that allows them to minimize taxes and transaction costs within the fund more effectively than many competitors. One fund here secretly tracks the market better, often making up for its small fee by capturing a few extra basis points of growth that the zero fee funds might miss. Performance comparison is where we see the data-driven reality. When you look at historical returns, the gap between Fidelity index funds versus Vanguard index funds is almost invisible on a standard chart. Both do an incredible job of mirroring the S&P 500 or the total stock market. However, there is a concept called tracking error. This measures how closely the fund actually follows its benchmark. Because Fidelity's zero funds use their own proprietary indices to avoid licensing fees, they sometimes deviate slightly from the standard indexes used by Vanguard. In some years, Fidelity might slightly outperform, while in others, Vanguard's more established tracking methods take the lead. This is where one company actually wins for those who want the most pure market experience. Now we get into the surprising differences that no one talks about. The first major difference is account flexibility. Fidelity is often praised for its lower barriers to entry. They offer fractional shares, meaning you can buy $1 worth of an index ETF if you want to. Vanguard has historically required higher minimums for their mutual funds, often starting at $3,000, though their ETFs have made them much more accessible lately. The second difference is tax efficiency. Vanguard has a patented process that allows its mutual funds to be as tax efficient as ETFs, which is a massive advantage in a taxable brokerage account. While this patent recently expired, Vanguard still has decades of experience in managing these capital gains distributions better than almost anyone else. The third difference is ease of use and the platform experience. Fidelity's interface is generally considered more modern and user-friendly, offering better automation tools for recurring investments. Vanguard's platform is often described as utilitarian and clunky, reflecting their philosophy of set it and forget it rather than frequent interaction. However, the fourth difference is the most critical: portability. If you hold a Vanguard ETF and want to move your account to a different broker, you can transfer those shares easily. Fidelity Zero funds are different. They are proprietary to Fidelity. If you ever want to leave Fidelity, you cannot move those zero-fee funds with you. You would have to sell them, potentially triggering a massive capital gains tax bill. One of these funds locks you in more than people realize, making Fidelity's zero-fee offer a Hotel California of investing. There is also a psychology factor at play. Why do Vanguard investors often stay invested longer? The culture of Vanguard is built around long-term ownership. Because the platform isn't designed for flashy trading, it encourages a more disciplined mindset. Fidelity's platform is so good that it can actually tempt investors to trade more often, checking balances daily and reacting to market swings. Behavior matters more than fees. If you save 0.03% on fees but panic sell during a market crash because you were playing with the app too much, you've lost the game. This factor matters more than expense ratios when it comes to your final balance. So who should choose Fidelity? Fidelity is the clear winner for beginners and those with smaller accounts. If you are just starting and want to automate every dollar without worrying about share prices or minimums, Fidelity is incredible. Their zero-fee funds are a great way to maximize every cent when your balance is under $50,000. They are also the better choice for those who want an all-in-one financial hub for their checking, credit card, and brokerage needs. On the other hand, who should choose Vanguard? Vanguard remains the gold standard for long-term investors with large portfolios, especially in taxable accounts. If you are planning to hold your funds for 30 years and want the peace of mind that your investment is portable and tax efficient, Vanguard is the way to go. Their ownership structure ensures that the company's interests are always aligned with yours. For the best index funds for 100K, Vanguard's VTI or VU are nearly impossible to beat for the serious, hands-off investor. Now for the $100,000 winner. Given comparable market performance, Fidelity Zero funds technically have a larger ending amount after 30 years due to the lack of expenses. The true difference is usually less than 1% of the portfolio value. Both are good choices. Delaying your investment due to analysis paralysis is the worst mistake, not choosing the wrong one. The investor who starts early and is consistent wins, not Fidelity or Vanguard. Watch out for the biggest investment mistakes as you go. The biggest mistake is focusing on small costs instead of the overall picture. Don't spend 40 hours finding ways to save $30 a year. Second mistake, transferring funds. Moving from Vanguard to Fidelity every few years disrupts compounding and may result in tax issues. Market timing is a mistake. Number 3, Fidelity and Vanguard funds fall in recessions. You must keep buying. Insufficient investment is a mistake. Number 4, zero-fee funds won't help if you don't invest enough. Fidelity index funds versus Vanguard index funds indicates investment is in its golden age. Both corporations have down expenses so much that individual investors now win. Choose Fidelity's zero-cost innovation or Vanguard shareholder-owned stability. Either is a good decision. Platform is less important than consistency. Time in the market beats everything, so pick your favorite, set up automatic payments, and let compounding work for you. Your future self will appreciate your $100,000 investment now.